SPACs, or special purposes acquisition companies, are an ever increasingly popular way of taking a company public without going through the long process of a traditional IPO.
If you watch our videos on IPOs, you'll remember that we mentioned that IPOs aren't the only way for a company to go public, aka sell their shares on the public market.
However, as a retail investor, it is important to know the risks associated with investing in, say, a SPAC as opposed to a traditional IPO or direct listing.
In this video, we're going to look at what a SPAC is, how they work, and whether or not they're a good investment.
Let's do it. A SPAC is a publicly traded shell company that is set up specifically with the focus of merging with the private company and taking it public. They're also known as blank check companies. So SPACs aren't a new phenomenon. They've actually been around for a long time, but they have been seeing a lot more uptake in recent times and are kind of the hottest trend on Wall Street at the moment. But are they a good investment? Let's find out.
In 2020, 248 companies went through a SPAC to go public, raising about 84 billion in capital. But in 2021, that 84 billion mark has already been crossed after only 3 months. A couple of SPACs that you may have heard of include DraftKings, which is a fantasy sports and betting website in the US, Virgin Galactic, which is Richard Branson's space travel company, Opendoor, which is a SPAC led by Chamath Palihapitiya. But how does a SPAC actually work?
Before we talk about that, let's do a quick high-level overview of how a traditional IPO works. So there are 4 main steps to a traditional IPO. Step 1 is hire an underwriter. And an underwriter you can view as basically the accountant of the whole IPO process. It's usually a big investment bank, and they essentially do all the paperwork, the regulation stuff, set the prices and valuation, and everything else to do with the IPO process. Step 2 is the roadshow. And all this is the private company market the IPO to investors and generate hype. Step 3 is setting the price. And this is when the underwriter works with the private company to set the price of the shares that are going to be sold and what valuation they're going to be sold at. And step 4 is the IPO itself. And this is when the private company's shares become available to buy on the public markets.
However, a traditional IPO has a few downsides. Number 1, it's quite pricey. This includes a lot of legal fees, hiring the underwriter, other fees associated with the IPO process. Number 2, it's a pretty long process. For planning alone, it can take 6 to 12 months. This primarily involves writing an S1 document. We won't go into too many details on this, but basically the company has to provide a lot of financial disclosures, and this takes time. And after this planning, it still takes another 6 to 9 months for the IPO to actually happen. So you're looking at somewhere between 1 and 2 years for the whole IPO to take place. That being said, the long process is beneficial to you and I as retail investors. The reason being is that we have plenty of information to help us understand the risks of a company, what the finances are like before investing in the company as it IPOs.
The process for a SPAC, however, is a little bit different, so let's dive into that. Step 1, a shell company is created. This is when an investor or a group of investors form a shell company, or in other words, the SPAC, with the intention of buying a private firm and taking it public. Step 2, this SPAC goes through a quicker IPO process and gets listed on a public exchange. Step 3, funds are raised. When the company is listed on a public exchange, that is when retail investors, such as you and I, can invest in the SPAC, and that's how the SPAC is going to raise its money. However, as often is the case with SPACs, the retail investor might not even know what the SPAC intends to buy. Generally speaking, the SPAC might inform investors of the general industry that they're looking to target or the type of company that they want to target, but really you're just putting your faith in the group of investors to make that decision on your behalf. Step 4, the SPAC finds a company that they want to target and make the acquisition. And step 5, the companies merge together. The SPAC becomes the private company, and the private company's ticker symbol, which was what you see on the stock market, generally changes to reflect the private company that has been merged with. It is worth noting that if a SPAC does not acquire a private company within a 2-year time frame, the funds that investors invested in the SPAC are returned to them. When you buy into a SPAC IPO, you almost always pay $10 per share, and that gives you warrants or options to buy more shares in the future at a low price.
The main advantage of a SPAC is the speed at which the company can IPO. A SPAC can usually get clearance from the SEC much quicker because they don't have many financial documents to disclose. Say versus our previous IPO example, where it could take between 1 and 2 years to IPO, with a SPAC, a company can do it in about 6 months.
So is a SPAC a good investment?
It's a leap of faith. You're putting a lot of faith in the investment company and their investors.
You also need to remember that due to its nature as a SPAC, there's also a lot less information available to you and I as retail investors before the SPAC happens.
Yeah, and there's a lot less regulatory oversight, so this can provide a lot more risk to an investor.
However, you do get the opportunity to invest in a recently public private company that could have substantial growth in the future. Are you interested in investing in any SPACs? If so, let us know which ones in the comments, and if this video helped you out, please do drop it a like, as it really helps us.
Thank you for watching, and we'll see you in the next one. Open Door SPAC made by Chamath.
Oh yeah, good luck with that. Chamath Palihapitiya.
Palihapitiya, Chamath Palihapitiya.